Hello, Jim here. Today I want to talk about my favorite strategy. That's the vertical put credit spread. But I want to show you what you can do potentially if a stock majorly drops, maybe because of earnings or bad news, or maybe just because the sector they're in is getting hit really hard. So I'm going to talk about how using the vertical put credit spread gives you a lot more choices. I'm going to talk about why it does give you more choices, what some of those choices are. And then at the very end, I'm going to share with you a trade that I did earlier this past week where I took one stock that dropped pretty majorly and was able to convert it to a cash secured put and really lower the strike on it, the short strike. I'm also going to talk about another stock that got hammered earnings wise, Sprouts, and I'll share with you what I plan to do with that stock. So stay tuned. I think it's going to be well worth your while. Okay, now why do I like vertical put credit spread so much? In my mind, and this is a great way to show you firsthand, is it gives you a lot more choices. You have a lot more control when a stock majorly drops. So I'm going to talk a bit about that. And then at the end, I'm going to share with you two examples. One I'm probably going to do this week and one I did last week, where you'll see this firsthand, how it can really help you. So what is a vertical put credit spread? Let's just jump into it briefly. So let's use an example. So say you have a company like Coca-Cola. Coca-Cola is currently, I think, like $68, $69. So maybe you want to sell a $65 put on Coca-Cola and you can pick up a lot of premium. You can make quite a bit on that 65 put, selling that $65 put. But then you look and you see, oh, wow, the $60 long put, I can purchase that for $13, which is relatively inexpensive. So I'm going to go ahead and do that. And that's what I encourage people to do. If the long put is relatively cheap, it makes sense to buy it. So once you buy it, that long put also retains its value. So, it'll lose value if the stock goes up. So you are missing out on a little bit of the credit. But if that stock goes the other way, goes against you, and it drops majorly, that long put can become worth quite a bit. And that's why it kind of locks in or hedges your potential losses, because you're protected with that spread. So in that case, it was a $5 spread. So your max loss, if you had one contract, would be that $5 times 100, 500 minus whatever premium. So say you brought in 100 premium, your max loss would be $400. Now, if you hadn't bought that long put and the stock dropped, let's just say Coca-Cola dropped down to $40 a share, you would have a significant loss. You'd have all the way from $65 to $40, which is like a $2,500 loss. So first of all, it protects you. But as that stock goes down and that long put gains in value, you also have choices with it. You can sell it and use that proceeds for other things. If it's been assigned to you, you can lower your strike price or your price you purchase those shares, or those shares are assigned to you. If it hasn't been assigned to you, you could potentially take different steps that we'll talk about here in a minute. But it does really give you a peace of mind. It's cheap protection in a lot of cases. I'm surprised, especially inexpensive stocks, how cheap some of the long puts can be. So I always encourage my members, my subscribers, everyone, if those long puts are inexpensive, go ahead and buy them. Now, if you can't do spreads, meaning you're new to trading options and you don't have that capability yet, it's still a good thing to learn. At some point, whoever your brokerage is, if it's Schwab, Fidelity, Robinhood, they're going to give you that ability once you've been trading long enough, and they're sure you're not going to blow up your account. They're sure you're not going to take crazy risk. You're going to do 10, 20, 30 contracts or do something you're not really, you don't have the understanding or you haven't learned enough to understand what the risks are. So once you get that capability, then that's when you look at buying these long puts and creating a spread versus just a cash secured put. So most vertical put credit spread trades can be closed early for a solid profit. So as you're setting these up, I also try to make so much per contract. I like to make $100 per contract. I like to do them usually 40 to 60 days and then close early. So a lot of them are open like maybe 20 to 30 days. And in most cases, that's what happens. 95% of the time, I'm able to close most of these positions for a pretty good profit. It's that 5% of the trades that I make that kind of go against me, or not really go against me, again, because I want to own the stock, but 5% where they miss earnings or for whatever reason, they get hit hard and they drop. Like, to give you for instance, Sprouts had okay earnings, but their revenue expectations, and they did miss on revenues, they dropped 25% this past week. That is one of the companies I'm going to talk about what I plan to do with it. So in most cases, that doesn't happen. Like I said, 95% of the time, it's just closing or a position early or letting it expire. Originally, I had most of my positions expire, but now I'm closing them early. I'm able to put those funds, so if I close something early, I'll open up another one. Every month, I try to close at least as many positions as I'm opening. I'd actually prefer to close more than I open. But I just wanted to emphasize that, it's only a small percentage to go against you. Now, the exception to that is if we go through a correction. Back in April, I think in 1 month, I had 7 or 8 positions get assigned to me all within the same couple of weeks. So it can happen, but, last time, so it happened in April. The previous time it happened before that was like in 22 when we had the market drop quite a bit in 22. So it doesn't happen that often. So next, what can you do when the stock drops? So in rare case, things, if it does go against you, here are your options. You can roll out. That's what most people do. You just go to a later expiration. Maybe you keep the same strikes. Maybe the stock has dropped some, but not like a crazy amount. I do tell a lot of members that, and I looked at all my trades, and this was earlier this year. I looked at all my trades, 21, 22, 23, and going into 24, and identified that typically things or stocks would not be assigned to you unless you were more than 10% in the money. So if you're dealing with a $100 stock and it's at $90 or $95, you don't need to be too fearful that that's going to be early assigned. Now, once it gets past that 10%, then the chances of it being assigned early goes up dramatically. And the closer you are to expiration, same situation. So some people will look at it in a different way. They might look at what's the delta at the certain time, or what the theta is. Does it have any more theta decay to measure that? But I'd like to keep it real simple. Look at that 10% rule. And it's worked out really well for me. So you can also roll down and out. And that's something else that I typically do fairly often, especially if it's bouncing around the current short strike. A lot of times I can roll down a little bit and maybe go out to the next month. The next one is to widen the spread. So, if you're dealing with a $5 spread, well, maybe you can widen it to a $10 spread and take it down another $1 or $2 for both the short and the long strikes. So that's something I've done a fair amount too, probably 20, 30% of the time. And then one of the things I've started doing in the last year is I'll take a vertical put credit spread and I'll convert it into a cash secured put. So you let the long put expire or you sell it, and then you sell a short put without a new long. So what happens is you buy back the short put, you sell the long put, and then you sell a new short put. So you're bringing in a lot more premium. Now, if that's hard to follow, again, wait to the very end of the video where I'll give you an example of what that looks like. So, and I have done this with one of the trades that I did last week. I did it with Dell. I also did it with AMD, and it's worked out really well. So, and there's two other stocks I'm probably going to do it with this week. So, and again, if you're comfortable owning the stock, and sometimes when a stock majorly drops, suddenly you're not as comfortable owning it. But, go back, look at the basics, look at the chart, go farther out with the chart, like look at the 5-year chart. Some of these stocks, if you pick them up near their low, you can have a fantastic return long term. And that's what happened after April. My biggest issue with a lot of the stocks I picked up in April wasn't that I took a loss with them, is I sold covered calls above the cost basis, but those stocks shot up and I missed some upwards potential. So that's another thing. If you do get a sign and you look at selling a covered call, take your time, do it above the cost basis. I do have what I call my checklist, my filtered checklist for covered calls. So in some cases, I might not even sell a covered call. And if you're assigned the shares, meaning and usually it happens overnight. So you look at your account the next morning and you see, wow, I own 200 shares or 100 shares of this stock, but then you have the long put. I typically, especially if the stock is down that day, I suggest selling that long put, and I take those funds and I put it towards the shares that I just picked up. So, say it's a $50 stock and I sell the long put and they're $3 per share. Well, my cost basis is 47, not 50. And I was, again, able to do that a lot in April, and I was able to lower the cost basis significantly for a lot of the stocks that I ended up owning or that were assigned to me. So key takeaways: vertical put credit spread is my favorite strategy because of its simplicity and flexibility. So a lot of times I start with a cash secured put and I just add in that long put. I look to see, well, how expensive is it? Does it take me, if it takes me from making 130 to 110, it's usually worth it to do it as a spread and to have that downward protection. You'll close most of your trades. So if you're using my strategy, which I like to use a 15 delta, I like to go around 40 to 60 days out, which puts you in a really good place. So a lot of times when these stocks dive, it's usually, I still have a little bit more room to work. And what happens is, if the stock quickly rebounds, because what will happen with earnings, a company will miss earnings, they'll get hammered, but then they'll kind of gravitate back to the mean. So it'll become profitable again for you. Now, if you're not going through like an earnings drop and the market's still moving sideways and up, that position can become very profitable. Usually around 21 days out, it becomes very profitable and you can close it early. But when needed, you have more tools to adjust. So again, the biggest takeaway from this video is you just have more choices. And if you want to own the stock to begin with, then the fact that you have a bigger tool chest, you can definitely, like we talked about before, you can convert it to a cash secured put. You can roll it out and down. You can widen the spread. There's a lot more choices versus if you just have a cash secured put. And then finally, always trade stocks you're willing to own and have the cash to cover it. I don't typically use margin, and it's worked out really well for me, especially I'm closing most of my positions at 70 to 80% profitable, and I'm able to turn these accounts over more and make more in the process. So let's actually go through an example, one of the positions that I actually did this last week. So stay tuned. Let's jump into that trade. Okay, I'm in my Patreon. This is what I typically share with my memberships. I will set up a trade, either a new trade or managing an existing trade. I'll make the trade, then I post it out to my membership literally right after I make the trade. So in this case, this happened on Friday. ODD, which is the Oddity Corp, It's an Israeli company related to AI in the beauty industry, and it's dropped pretty majorly recently. I believe it was in the mid 60s, and it's dropped significantly. If we actually look at it, we go out here. Let's see if we can. Here's ODD. And if we look at the chart, yeah, you can see it's dropped quite a bit recently. Now, if we go out, I don't know if we can do the 5 years. Yeah, so it came all the way up and then dropped back down. I think it's a really good company. It's got good profitability. It's got good growth. It doesn't pay a dividend valuation. I don't know that I agree with this. It may be in the wrong sector, but it only has 22 million in debt. Pretty good amount of cash. The growth is pretty substantial. If you look at its earnings, it's growing earnings pretty quickly. $2, 235, then to 281, then 354, and then 429, then 515. So you can see it's steadily growing. So just overall a good company, but it still recently got hammered. And we'll play around with it a little bit here, but this is a trade I did literally on Friday, that 2 days ago, it's Sunday. So trade, I rolled two vertical put credit spreads on ODD expiring on 11/21/25 with strikes of 55 and 45 to a CSP. So what I talked about before, I literally did not buy the new long put. So I sold the 45 and I bought back the 55 and I lowered it all the way down to $50. But I brought in another $576. Now this is that how many contracts? It's 2 contracts. So I made quite a bit of premium. So here I just talk about what I liked about it. I share what the annualized return would be if you were able to do this the whole year, 65%. I mentioned that I like ODD. I believe they will gain some momentum and jump back into the 60s or 70s. Oddity Tech Ltd. operates as a consumer tech company that builds digital brands in beauty and wellness industries in the United States and internationally. And here's some of the stuff I talked about, going from 209 to 515. Track record, they do have earnings coming up on the 20th. So the track record has been 4 quarters they've raised full year in EBITDA. They literally have not missed. They've only increased it. So they're very conservative, almost like a Zoom. If you've watched me before in some of my previous videos, Zoom, it always over delivers. It under promises and over delivers. And that could be what might happen again here. So I believe 50 is a good price for them. So my cost basis would be right around 46.51. So, and if you look over here, I'm not too far, 45.25. So I was able to lower that position and do pretty well. And here's the actual trade. So I brought in 21.79 by selling the new short. By buying the existing short, I spent 23.22. And then I was able to bring in a little over another 700 by selling the long. So it allowed me to, like I showed before, bring in quite a bit of cash, 576. Now, if we look at this trade currently, I could have also rolled it. So I could have rolled it out to December, but I would have had to pay you probably around $2 to $1 or something along those lines. I could have rolled it out and probably brought in even more. So with Schwab, their interface is fairly easy to work with. With Fidelity, you actually have to do it like 2 trades. With Schwab, I could literally delete this long put and see how it suddenly turns very profitable. So I could, and this is one contract. The one I showed you a minute ago in Patreon was 2 contracts. So I could potentially make 380, but I would want to bring this down. So I could see, well, can I bring it down to 50? And I could, pretty much break even. So I have that choice. Now the numbers look a little bit weird. It is over the weekend, and I'm not sure the numbers are completely accurate here. The other thing I could do is I could go out to, I believe if I wanted to, I could also do 3 contracts. And I think I might have done that because I believe that they're going to go back up and they're going to be into the mid 50s. So you could go from 2 contracts to 3 contracts and potentially lower it even more. So you could say 45. No, so 45 won't work. I didn't end up having to spend about $1.75 per contract. So I would probably go back to 50 and I could potentially bring in $710. Whereas in the trade I did on Friday, I brought in a little bit less. I brought in, what was it, 576. So that's another choice. You could go out, or you could do what I did and go back to 1121. And you can see here, it's pretty close to what I got, 579. So I kept it the same month, which the reason I did that is with the expiration being in, what is it? I do like how you can do this with Schwab, but I can see it's in 19 days. Tomorrow it'll be 18 days. So there's also a good chance that over the coming 2 or 3 weeks, as it gets closer to earnings, it may start bouncing higher, primarily because they typically, like I said, under promise and over deliver. So this is how I would look at this trade. This is, so you could still potentially make this trade on Monday. And if you hadn't set this up as a vertical put credit spread, you'd have a lot fewer choices. So if we remove this and we were just trying to roll, you'd have to take a loss. You couldn't do what I did so buying that long put originally just gave me a lot more choices. Here I'd have to take a little bit of a loss. If I went out to 12.19, I could potentially still have done it, but I wouldn't have been able to take as much of a profit. So it definitely gives you more choices and different things you can do. I could have also widened the spread a little bit. I could have done, instead of, this was originally 55.45, I could have done, in the new trade, I could have done 50.35 or something along those lines. And I've done some trades like that too. So next, let's jump into another stock. I wanted to show you another one that I am going to do a similar situation like this. So that's Sprouts. Let's take a look at Sprouts and see what happened with them this past week. Okay, the second stock I wanted to talk about, and I currently have this position, and I'll probably manage it tomorrow or Tuesday. But Sprouts missed earnings. So if we come over and we look at, they actually beat with normalized earnings per share and GAAP, but they did miss in revenues. And I think their guidance was not the best guidance. And because of that, they just got hammered. Now, on Friday, they were up, but on Thursday, they were majorly down, like almost 25-30%. But you can see here, if we look at the last 5 days, they're down 26-13. So you can see they just went off a cliff. But what I've seen happen in these cases before is the stock will slowly rebound over time. I like them. They have fairly good profitability. Growth isn't bad. I still like to shop at Sprouts. So they have a lot of things to like. Even the earnings estimates is, not as good as ODD, but it's definitely increasing, 527 and 25. And then by 2030, 888, so that's a pretty significant increase. So did it warrant such a drop? I don't think so. I believe it's a bit oversold. When I first traded them, I believe it was in this 100 range. My position is 90 over 80. So both the short and the long are in the money. So how would I manage that? One thing I like to do is I do like to use Schwab's interface. I'll use their trading page. Most of these trades that I'm sharing with you here are in my Fidelity. They're in my retirement accounts. But I just find the functions and features a little bit better in Schwab. So sometimes I'll go in the trading page in Schwab and just see how things play out by, changing the trade to see what might work the best. So here, if I rolled it out to December 19th and I kept the 90/80s, I would still have to spend between 330. I might make a little bit, but that's probably unusual. Again, it's Sunday, so the numbers are probably a little squirrely. But one thing I could do is I could come over here and I could say, well, let's lower this to 60. Wow, suddenly we're making a little profit, and I want to lower this to 85. So it looks like I could make a little bit. Could I go even lower than 85? Could I go to 80? And I'd have to spend anywhere from 440 to 220, or maybe nothing at all. A lot of times, if this is what I want to do, I may try to just spend a small amount if I want to, take it to 80, 60. But you see here, these are all zeros, so I don't know what's going on there. There's probably just no volume. So this is one of the things I can do. If we tried 80, 70, you would have to spend quite a bit. Yeah, anywhere from $5 or $6 to 380. Maybe you get lucky and do a 150. So those are some of the choices. Now, if the stock hadn't, dropped so much, say it had been in between the 90 and 80, you'd have a lot more choices with this kind of a roll. Now, what I really like to do is go ahead and remove this long put. So I just take this out and see here we have it at 80, and I'd spend 440 to 220. So I'd still spend some, but I can probably, usually right in the middle, I can make some cash. So I could maybe go up to 85, meaning above the long put. And they're currently at 79.27. After hours, they're up. So they're really close to, let's look over here so we can see it. So it's 79.27. So they're already recovering. They could be in the 80s. So, maybe this coming up week, if it's a good week, they get back to 81 or 82. And then if I sell this cash secured put expiring on 12/19, I could also try 11/21 again, like I did before. And I could potentially spend a little bit, turn it into a cash secured put at $85. But I typically like to make a little bit more. So I would probably look at going this route. If we look at the trades, I just want to see what the bid and ask looks like. So the volume, not bad, 19 volume. Looks like fairly good open interest. So I might see, can I get anywhere near this $3? So I might look to see, I might do the ask at $3, fire it off, review it, fire it off, see if it'll go through, because if I can sell it for $3, then I can lower this to 82. So I'm within $1 or $2 of what the current price of Sprouts is after a 25 to 30% drop. And I would play around with these. I could also, if I have plenty of cash, I could say, well, maybe I'll go to two positions, and then suddenly I can bring in a lot more cash. I could say, well, maybe I want to own it at 70. I'd have to spend some 75, still spend a little bit. I could go all the way down to 80. And this is like what I did with the other trade, but you have more choices. You can make more decisions with it. And a lot of it has to do with buying this long put originally. If you hadn't purchased that, like I said, you wouldn't have as many choices. You'd be just rolling one cash secured put to another, and you could potentially go to the same level. And this is because I have more, so go back 1 to 1. So you could potentially roll it. You'd have to be at 90. So if you wanted to go down, you'd probably have to spend some. Yeah, you'd have to spend anywhere from $5 to $2.90, or maybe as low as $80. So this is what I look at. I play around with it. I figure out what's best. I typically will always try to bring in more of a credit. On occasion, I will take a little bit of a loss if I just need to improve the position, or maybe I just don't have a whole lot of cash again, because this is in my retirement accounts. It's either in my IRA or Roth. So And it, like I said before, it just works out really well. Gives me a lot more choices starting with a spread versus just a cash secured put. So let me know what you guys think. Do you do something like this when you're trying to manage your trades? And again, if I do get assigned the shares, then a lot of times I will sell the long put and bring in a fair amount of money. Like we can look here, if we go back to 1121, we go back to the 80s. So say, you know, Sprouts gets assigned to me and I own them tomorrow, I could sell this long put and bring in anywhere from 370 to 390, which I then can put towards, this $90. If they gets assigned to me, it would be assigned to me at $90. So I could lower it to around 86 and change, if you get my drift. So let me know what you think. What do you guys do? Do you do something like this? And has it worked out well for you? As always, thanks for taking the time to watch the video, and I hope you have a wonderful day.